programs, training programs for working professionals and academia, and various investor education initiatives. Today's webinar topic is Financial Well-being for Women. So, for this, we have with us Kiran Telang. Ms. Kiran Telang is a CFP and investment advisor registered with SEBI. She is an author of Mindful Retirement and Moneywise Perspectives for Women and has a work experience spanning over 2 decades in banking and personal finance industry. Ms. Telang is also a part of several financial literacy programs and is also a guest faculty at IIM Indore. Now, I would request Kiran ma'am to begin with the session.
Thank you for the kind introduction, Mansi. Very warm welcome to everyone attending this webinar today. So we are at the end of the month that celebrates Women's Day, that's 8th of March. So while we could not do this webinar on 8th of March, we are presenting this to you today. And hopefully you go back with some food for thought and some concrete action steps to take care of your finance. So without any more delay, let us start with the presentation. So the topic today is financial well-being for women. My introduction has already been given. My new designation is I'm the Director and Principal Officer of Dhanayush Capital Services Private Limited, which I founded in 2014. And Mansi already mentioned the 2 books that I have authored, Mindful Retirement and Moneywise Perspectives for Women. I will just let you read this for a few seconds. NISM introduction has already been done by Mansi, so I will not read this out for you. So for this session, we will have a Q&A at the end of the session where you can put down your questions in the chat box and we'll try to answer as many as possible. And all participants will receive a participation certificate within 3 to 4 days. And the recording of this session will be available on the NISM YouTube channel. So let us start with a poll. Sahil, can you please run the first poll?
Yes, ma'am, done. It's live.
Yeah, we'll just take a few seconds to take this poll. Who manages financial decisions at home? There are 4 choices: mostly me, mostly partner, jointly, or someone else. Okay, let's close the poll. Mansi, can we see the results, please? Oh, very nice. I'm so happy to see this result. It says 47% take joint decisions, 17% the decisions are taken individually, and we have 23% for partners taking the decision, and someone else is taking a decision for 13%. So this is encouraging, where actually between a couple joint decisions are being taken, but we still have a very long way to go where women actually have more say in the financial decisions of at home. So let us move on with our presentation. See, when we do these kind of sessions, or even when we are talking to a group of women investors, these are the questions that keep coming up again and again. So is it really that women think differently about money than men do? Or do all women have similar behavior when it comes to finances? And do women really need differentiated financial products? Aren't all the products applicable to both men and women? And are women better or worse investors? There is always a comparison which is done. And the big question, can women actually handle financial decisions? So these questions keep coming again and again, year after year. So I will share a few of my thoughts with you, while you also should ponder over these questions as related to your own life and own community. So I think women do think slightly differently about money in terms of, how money is to be utilized, how money is to be saved, how it is to be invested, what are the goals. So there has been some research done in this area, and behavior of women slightly differs in terms of money thoughts. So I will come to it in the next slide. And do all women behave similarly when it comes to finances? Well, this is a very generic kind of answer, if I would say. Uh, but I truly believe that each family is different, each woman is different. When it actually comes to managing money, women behave very differently. I mean, they look at their own circumstances and behave accordingly. So I don't think there is a different kind of behavior when it comes to money between men and women. And do women need differentiated financial products? Well, financial products, whatever are available, are mostly 95% of the financial products are gender agnostic. So both men, women, or other genders can use it to fulfill their financial goals. But there are certain financial products which specifically cater to women investors, and they have some genuine benefits. Otherwise, most of it is hogwash. So if you think about credit cards which offer extra shopping discounts or things like that, which is very minuscule, it really doesn't make a difference to your life. But if you come to things like uh, maybe a differentiated rate of interest on home loans for women purchases, so that actually makes a difference in what you're paying for a house. So these kind of products are really helpful. There could be insurance policies that cover women specific illnesses, so if there is a requirement in that area, maybe that policy could serve a better purpose than a generic health insurance policy. Are women better or worse investors? Well, again, research says that women generally turn out to be better investors than men. Again, I will come to that point later in the slide. And can women handle financial decisions? Well, I leave that question to you. Our finance ministers are women. A lot of our biggest institutions are headed by women. And a lot of you would be managing your own money as well. We saw in the poll that we ran, 47% are managing finances jointly, and 23% were managing it on their own. So I think this is a question that you should be asking yourself: can I handle my financial decisions on my own? So when I was talking about some surveys, so there are certain myths that these surveys break. So the myths are that women are risk averse. They will not go into products that are risky or volatile in nature. So typically, women are associated with traditional investments like gold or like real estate, which are considered to be safe and non-volatile and simple, or even for that matter, bank fixed deposits, which are simpler to understand. The second myth is women are not good with numbers. Again, a big question mark. In this time and era, we should not be even talking about these things, that women are not good with numbers. And women cannot understand finance. It's too complicated. As I said again, we have a women finance minister, and so many women who are heading institutions, and they definitely understand finance much, much better than a lot of people around here. So the reality, what comes out of these surveys that were done for women investors, is that women are more disciplined when they invest their money, and women generally have a very long-term thinking in terms of investing. So they don't act on whims. They avoid impulsive decisions. When they are actually investing, they think of their long-term goals, how their investment behavior is going to affect their families, how is it going to affect their own lives. So that kind of makes them a better investor, because they are not really trading, and they leave the money for a long time in the investments, and that is what really earns them better returns over a longer period of time. I think let us run the second poll over here, Mansi.
Yes, ma'am, doing. Wait a minute. Ma'am, done.
Yeah, so this is the second poll. How confident are you managing your own finances? So there are four choices. Please select that. We'll take about 10 seconds to answer this poll. Okay, let's close the poll. Can we have the results, please? Oh, super. Very good. So I think if women are so confident, I think this session will be like a brush up or a refresher for what you've been doing so far, and probably pick up a couple of points which might help you think differently if you are thinking in a certain way. So why should financial well-being actually matter to women? I mean, is it even a topic worth discussing? So let's look at some ideas. So longevity is very well known that women live longer than men. So in India, the latest numbers say that men on an average live 70 years, whereas women are living up to 74 years. So there is a 4 year age difference, and that is average. So if you look around you, there are more women who are living longer than their spouses. So you will see a lot of women who are into their old age, and I mean, they have lost their spouse. Women also tend to have more career breaks. So one is a maternity break which they take, so that obviously impacts the career in some way, because if the break is a little longer, they might lose out on the seniority position, and that will also obviously impact the income. Obviously, there are also other times when there is a need for someone to take care of an elderly family member, or there is somebody ill at home. So it is generally traditionally the woman who takes a break from the career to take care of these home responsibilities and caregiving responsibilities. So that again creates a career break, and that career break results into lesser income. That again comes in the way of gender pay gap. So not all places, but still many places have a differentiated pay between men and women. So some places women tend to earn lesser than their male counterparts. And because of all the career breaks that they're taking for caregiving or for maternity, there is a normalized break or a reduced income which comes into them. So they are earning less, they are saving less, and they're investing less. So that is how that uh, gap comes in. And then again, there are cultural and societal beliefs that we were talking about earlier, in terms of women are not good at maths, or women can't make their own financial decisions. So all these things actually, end up, families end up bringing up their daughters differently than how they bring up their sons. While this is gradually changing, there is a large part of the country which still has this differentiation, and that is what creates a lack of confidence in women as they grow up, and a lack of confidence to handle the money and their financial decisions on their own. So there is a long way to go. While I'm very happy that the audience today has confidence in managing their own money. So when we talk about financial well-being, I think there are 3 points that come out of financial well-being. I mean, what do you get by being financially well? So one is that you have control over how do you want to live your life. So how you want to live your life to a large extent depends on whether you're financially stable, whether you have the stability to take financial decisions on your own and in the way that you envisage your life to be. So that control is a part of financial well-being. Second is clarity. You know at any point in time where you stand with regards to your finance. So whether it is where the money is coming in, where it's going out, or how will you reach certain financial goals that you have kept for yourself. So you have that clarity at any point in time. And third, obviously, is the confidence. So once you have control, you have clarity, you will have confidence in navigating the ups and downs of life. So whatever life throws at you, whether it could be good times, bad times, or life is just going as a routine, you will have the confidence to make the financial decisions that come with it and live life to the fullest. So I think that is a very, very well-rounded way of looking at financial well-being. So having said that, how do you actually go about looking at financial well-being? So I think these are a few points that we need to be aware of in terms of how you should be looking at your financial well-being. The first is goal setting. We will look at each of these aspects slightly in detail, though we only have about 45 minutes for this session, but we will just go into each of these points. So goal setting, cash flow, budgeting, protection, investments, estate planning, and financial hygiene. So if we talk about goal setting, the name itself suggests that you have to set certain goals, and each goal can have a financial number. So if you're talking about responsibilities, so responsibilities typically in the Indian family setup, if you look at a typical life in an Indian family, it could be starting with, say, if you're paying for your own marriage. So typically till the education, the parents are taking care. And after that, if you want to take care of your own marriage expenses, that could be the first responsibility. Then come along the kids, so you have to pay for the schooling and the higher education. You will at some point buy a house, you will some point buy a car so that the family is more comfortable. There could be at a later stage, there could be responsibilities of probably taking care of elderly parents if they're not financially independent. There could be your own retirement. So these are typically responsibilities that we can put across, and we can put certain numbers to these responsibilities. So those could be your basic goals. There are aspirations and dreams. So aspirations could differ from person to person. It could be something like starting your own business. It could be donating to certain charities. It could be building up some organization, some philanthropy setup of your own. Dreams could be maybe having a long holiday, maybe a world cruise or something like that. So those could be dreams. And you can also have goal setting in terms of achieving financial freedom. So financial freedom is a very broad term. It could sometimes be confused with the word FIRE, that is financial independence and retire early. While that is a more restrictive thought, I think financial freedom is a very broad thought. So financial freedom is actually where you can, take care of all your responsibilities, your aspirations and dreams. You have sufficient money to provide for those, and you don't have to really, think about money when you're taking certain decisions in life to pursue certain aspects, to pursue certain dreams. So that is when you actually achieve financial freedom. So when you're setting your goals, you think in these terms. So responsibilities, aspiration, dreams, and financial freedom. Typically, what happens is in the early part of your career where you do not really have that vision of the kind of responsibilities that you will have to take, you can probably just have the broader goal. So you are going to retire someday, so retirement could be one goal, and leave the rest of the money to a goal titled financial freedom. If you're you want to tag everything that you're doing, why are you doing that? So I'm doing this for my financial freedom. So that could be one way of looking at things. And as you progress, probably you could have more labels. So while there is one pot of money that you are collecting, you can have smaller buckets in that, which are allocated to each of these goals that you have set up for yourself. So once you have set up your goal, you know what you're going to do, but how do you actually achieve those goals? So it begins with cash flow. So you have to know what comes in. That is pretty simple because your sources of income are pretty limited. So you could either be earning a salary, or you could have a business which gives you money, or you could have some inheritance coming in, or probably there are certain assets like a house which is giving you, say, a rent, which is an income again. So you have to collate all your sources of income, which is simpler. The bigger part, the problematic part, is what goes out. Do you actually know what you're spending? See, nowadays what happens is we have so many avenues of spending. So while we don't use cash, most of us have now moved to the digital payment. So it is either online banking, mobile banking, you use the UPI route, you issue checks. These are the primary sources, and obviously credit cards. So these are the 4 5 ways in which you spend money. Cash has obviously become very less now. But when you have so many outflows of money, you don't really know where you're spending. So one of the key parameters to arrive at your cash flow, you have to measure what is going out, where are you spending money. So devise a plan what works for yourself. So not everybody can maintain a diary or an Excel sheet of what total expenses are. Do whatever helps you. You can use some digital resources also, which help you in collating your data, but be careful about possible frauds or leakage of data that comes in with all these online sources of tracking your money. But set up a system for yourself. Worst case, if you're not able to set up a system, at least look at your bank statements, because eventually all money goes out of the bank. So you look out at your bank statement and see where your money is going, how much you're paying for your credit card, what is going through your UPI, what online payments are you making, and that is how you will kind of arrive at what are your expenses. And you need to know from the cash flow what is the surplus that you have. So if you see that the surplus is very less, you will have to then get deeper into your expenses, and you will have to figure out where you are spending unnecessarily. What is it that can be cut? So if you reduce your expenses, that is when you will be able to have a larger surplus. That brings us to the next step, budgeting. So budgeting for most young people probably would be a very negative connotation, but it is not a restriction. It is actually an alignment. So, you will align your expenses towards what matters to you. You are not just spending because the money is lying in your savings account, or, you have a credit card which you can just use anytime and splurge. So if you have an alignment with what you are saving for, we have already set our goals. So if it is a dream or even if it is a vacation for which you're saving, unless you do budgeting and create that surplus to invest, it will be a little difficult for you to really achieve your goals. On a very, very basic way to look at how to do budgeting, you can use a 50-30-20 rule. Please understand that this is a thumb rule. It does not apply to everybody. But if you're not doing budgeting, this could be a very broad parameter to set up your budgets. So 50% of your income should go towards your essentials. 30% of your income should go towards your discretionary expenses, and 20% at least should go towards your savings. So essentials, how do you define essentials? So it could be rent if you're living away from home at a younger age, when you're starting your career, or even at a later age. This is just an example of a salary of 50,000. If your salary is higher, or if you're higher up in your career, obviously these numbers will be very different. So this is a very basic rule. Now, for somebody who's living on rent, it could be an essential expense. Your food and grocery could be an essential expense. Your internet and your mobility, your transport could be an essential expense. Discretionary is all that you can live without. I mean, while you are spending because you have the money, but if it comes to a very difficult situation, those are things that you can cut down on. It could be entertainment, eating out, ordering in, splurging on shopping. All those kind of things come into your discretionary expense, and 20% obviously savings. Now, how will this differ over a period of time? So somebody who's not living away from home, who's still living with parents, the rent portion would go away, right? So there will be more money which is available to save. So instead of putting that money which you're not spending on something like rent and moving it into the discretionary bucket, move it into the savings bucket. You will have a very good savings rate in the initial years if you don't have any financial dependence, or if you don't have to pay for essentials like rent. So in the first 10 years, most youngsters lose out that period because they are either not saving enough, or whatever they save, they are trying to do trial and error on different new things that are coming. While that is fine, you do learn by trial and error, but have some kind of bucketing strategy for yourself, where you have your core investments into the traditional or tried and tested route of creating a portfolio, and keep some money which you're okay to lose into all these trial and error things that you're doing for the newer products or the newer ways of investing that are coming into the country. So this is how you start your budgeting, and this is how you plan your expenses. So you have done your goal setting, you have looked at your cash flow, you have kind of arrived at your budgeting. So you know what your surplus is. What do you do then? The next step is not to invest, but next step is to protect yourself. Because if you don't create a protection for your family or for yourself in a financial arena, whatever you save and invest will be paid out for all these accidents that can happen. So if there is a financial loss to the family because of death of the primary income earner, or if there is a disease which causes hospitalization, or there is an accident which maybe causes a disability but maybe also just causes a long recovery period, there could be job loss, there could be investment losses, there could be frauds because of which you lose money. So you need to protect yourself against these kind of things. So how do you actually do how do you actually protect yourself from these? So some of these can have insurance policies, right? So first thing is, we look at the contingency fund. When we are creating a financial plan for anyone, the first thing we look at is a contingency fund. So contingency fund is something which can be liquidated and be available to you at least 1 day's notice. So if you are putting some money, say in a bank fixed deposit, the bank fixed deposit can be broken. I mean, if it's an online FD, you can just go to your net banking and withdraw the fixed deposit. If you're using something like debt mutual funds, you have a 1 day notice period, after which you can, I mean, if you put in the transaction today, the money will come to your account tomorrow. So it should be very, very liquid. So this contingency fund helps you in different ways. It can help you in case of any emergency hospitalization. It can help you if there is a job loss. It can help you, if there is some COVID-like event where there were pay cuts which were done for a longish period of time. So these are the funds that will help you tide over those difficult times till you figure out what actually you want to do in the long run. The next is any hospitalization, you obviously need a health insurance. So health insurance will save your investments. You don't have to break your investments to pay for hospitalization. The health insurance will pay out for that. In case of death of the primary earner, life insurance becomes mandatory. So in life insurance, whatever is your sum assured, that is what will be paid to the family in case of death. So suppose you are taking a policy which has a 1 crore life cover. So in case of death, the family gets the entire 1 crore. Now there is a differentiation when you take a life insurance policy. There could be policies which are purely protection policies. They are known as term. There are other policies which also have an investment component. So those are called, savings cum insurance plans. So in a term plan, there is nothing else. I mean, you keep paying the money. If death happens, the family gets the money, the nominee gets the money. If you survive the period, so suppose you've taken the policy for 25 years and nothing happens in those 25 years, you survive those 25 years, then nothing comes back to you. Whereas in an insurance cum savings product, there is an amount that you pay every year as a premium, out of which some money is paid towards the mortalities to pay for the policy in case of death, and a small amount goes towards investment. So if, like in the previous example, suppose there's a 25-year policy, you pay premiums for 25 years. At the end of 25 years, you get something back. Now, most people would find getting back the money as a very lucrative option. Why should I pay when there is nothing at the end of it? So the differentiation is huge actually. So if you pay for a term plan, the premiums are very, very low. Whereas if you pay for a plan which has a savings component built in that, the premiums will be much higher. The cover will be much lower. So when you're going for life insurance, ensure that you have a decent sized term plan, so that in case your income is lost, there are financial dependencies on you, your family is not suffering because of loss of that income. That entire large chunk of money should be available to the family in lieu of the income that they're losing. The third policy good to have is a personal accident policy. This is something that has a clause which gives you some kind of income in case of a disability, in case of there is an accident and you're not able to go to work. So usually these policies pay some amount as a weekly benefit in lieu of loss of pay. There is also a disability clause in that. So in case there is a loss of limb or loss of eyes or loss of hearing, there are certain specific amounts that get paid out. So suppose in a 1 crore policy, there is a loss of one limb. In that case, say 25% gets paid out. So 25 lakhs will be paid out from the policy in case there is such an accident. So this also helps cover, financial losses in case of any such unforeseen event happening. The fourth policy that I would like to talk about is the critical illness policy. This pays in case of any critical illnesses being detected. So basically something major like a heart disease or cancer. So it is a predefined list of illnesses against which the payment happens. So critical illness is also good to have policy. So all these policies you should have a look at. You should weigh against premiums and what you can afford to pay, and then decide on what you need to have. So health and life insurance is primary. Personal accident is also, I think, a very necessary policy. Critical illness, you can choose whether you want to take it or no, because the premiums are slightly higher on that side. So these are the four policies that you should at least look at. Then we come to investments. So in investments, these are the few things that you need to understand. You should start investing early. Don't delay your investments. You don't say that, I will start earning only when I have a larger salary. Right now, I don't have any money to invest. See, you don't need a large chunk of money. Even small amounts help. In Hindi, there is a saying, "Boond boond sagar bane." So even if you have a very small amount to invest, mutual funds allow even 100 rupee SIP. I mean, I'm sure the people who are on this webinar are definitely capable of doing much more than that. So having a smaller salary or a smaller saving is no excuse not to start your investments. you should stay consistent. So once you start investing, don't keep breaking your investment cycle, because that will cause a loss of compounding in the investment that you're building. And you should avoid chasing returns. So chasing returns is, I mean, you will jump from something that is giving you the best return today to another one which is giving a best return tomorrow. So stop chasing returns. That is not going to help you. What is going to help you is staying consistent and being able to continue your investments for a long period of time, and optimize your savings and investments. So I would say, rather than optimize, I would also say maximize. I mean, in the early part of your career where your financial responsibilities are much lower, you select a good investment and try and maximize your investment amount into that. So see, if you're looking at some investment, like say I will put 10,000 rupees in a particular stock which I think will grow 4 times. So even if that 10,000 grows to 4 times, it will become 40,000. What difference will it make to your life? Rather than that, if you have a consistency of putting 10,000 every month in, say, a mutual fund SIP or into even a recurring deposit, that will give you a very consistent kind of a return, which will really help you build up your corpus over a period of time. So instead of chasing returns, stay consistent in good products. Understand asset classes and understand asset allocation. So we'll come to that in a bit. So I would like to just show you this example of what cost of delay is. So when I said start early, so here are two people aged 25 and 30. So if the 25-year-old decides to invest 10,000 per month and say the expected return in a particular product is 10,000 rupees, what are the accumulations that this person will make by the age of 35, 40, and 60? So if you see, by the time 60 arrives, this person will have 3.79, 3.8 crores almost. Whereas a person who delays the investment by 5 years, the same amount will reduce to 2.26 crores. So this is just this delay of 5 years that has caused this reduction in the amount that is accumulated. So that is the reason, whatever amount you have, whatever you can save, please start investing at the earliest. Don't delay till you think you have a larger amount to invest. Now, when I said that you optimize your investment, I was also talking about maximizing. Now, the same 25-year-old investing 15,000 fixed till the age of 60. Every year, this person, just every month, they are investing 15,000 till they turn 60. This person will get about 5.69 crores at an expected return of 10%. Whereas if this person decides that I will put 15,000 every month for the first year, in the second year I will increase it by 10%, in the third year again I will increase it by 10%, and this goes on. So by the time this person is 60, look at the amount that he is able to accumulate. It's a huge number, right? So this is just because they are increasing their investment. So typically what happens is when your salary increases, you end up increasing your expenses, but you don't end up increasing your savings and investment. So if you look at it, that if your salary increases by 10%, try and increase your savings amount also by 10%. So that is how you will be able to achieve this. So in a SIP model in mutual funds, there is something known as a step-up SIP. So you can probably automate this thing by doing a step-up SIP instead of a constant SIP. So that step-up will, give you this increase every year. I will keep it brief here. When I spoke about asset classes, these are the typical asset classes that we invest in. There are a couple of more things that can be invested in, but we'll keep it simple here. There is debt, there is equity, there is real estate, and commodities, which are typically investments are available in gold and silver. So when you talk about debt itself is a very large asset class. So the simplest products in debt, what you can understand, is a fixed deposit. It could be either a bank fixed deposit or a company fixed deposit. So all kind of fixed deposits are debt products. So essentially, if you want to understand what is debt, so debt is when a debt investment when you make, you are basically giving your money to an institution which promises to pay you back your principal and a certain interest on it, which is already fixed. So that interest is given to you, and at the date of maturity, the principal is returned back to you. So you are basically lending money to somebody, and somebody is paying you back that with interest. That is the essence of debt. How this plays around in different products is different. In a bank fixed deposit, you're lending money to the bank. and the bank is paying you fixed deposit interest, and on the date of maturity, the money comes back to you. The same goes with company fixed deposits. There are government papers, so it could be T-bills, it could be government securities, it could be bonds. So again, you give your money for a specific period, and there is certain interest which comes in, and on the principal, the money comes back. The basic underlying of debt investments is same. Now, how it is presented to you in different ways might differ. So even your products like PPF, your postal savings, your national savings certificate, all these are debt products. There are also debt mutual funds, which the underlying again is any of these debt products. It could be corporate bonds, it could be government bonds, it could be fixed deposits, basically, which are called as CPs and CDs. So all these things are there in a mutual fund. A mutual fund essentially combines a lot of these things into one scheme and offers that scheme to you. The difference in each product would essentially be on the tenure, on the risk. So that itself is a class, a session by itself. So I will not go much deep into that. So essentially understand that debt is more or less a fixed return product. Equity, obviously, we understand as investing in stocks of a particular company. So when you talk about equity, the base of equity is that you are participating in the business of a particular entity. So if you buy shares of XYZ company, you become a part owner of that company. So whatever profits the company earns, whether it distributes it in the form of the dividends to you, or you get the capital gain in terms of increase of the share price of the company, you are a owner, so you will get the benefit of both these. So that is what equity is. So you can either buy direct stocks, you can use the PMS route, which is a portfolio of stocks. You can use mutual funds, which have different schemes of differing flavors: large cap, mid cap, small cap, hybrids. So there is a range of products in mutual funds that have an equity exposure. So you can choose what suits you. Real estate obviously has been a very traditional and favorite investments in India. So real estate could range from homes, residential projects, it could be commercial projects, it could be land. We also have real estate investment trusts, REITs. So REITs you can invest directly, or REITs exposure is also received through the mutual fund route. So a lot of mutual funds also handle REITs. Commodities, obviously the physical gold, silver, coins, jewelry, uh, sovereign gold bonds are available on the secondary market now. There are gold mutual funds, there are gold ETFs. So all these are the ways to invest in gold and silver, which are the primary commodities that are being traded. So each of these asset classes has its own risk and return profile. So you should understand what risk you are comfortable with and what is the kind of return you can expect from this. So you can probably create a combination of each of these in a certain proportion. So that is essentially what is known as asset allocation. So you don't buy the same asset class for 100% of your investment. So if you have 100 rupees, put say 20 rupees in debt, put say 50 rupees in equity, and some amount in commodities. Real estate is a very big ticket item. So you will really have to be careful how much money you're putting in real estate, because that will block a large part of your income. So if you're taking a loan and buying a house, your EMI could be substantially large and you will not have much amount left to invest in other asset classes. Now, how do you actually select investments? So if you look at it in two ways, so there are product attributes and there are personal attributes. So let us look at product attributes. So there are three things: safety, liquidity, and growth. Now, when you talk about safety, so first of all, the product safety in terms of whether it is a regulated product. So if it is a regulated product, the safety is much higher rather than it being an unregulated product. Safety, again, looking at whether the company will be able to, company or any institution where you're putting the money, whether they will be able to return your principal and any profits or interest that are earned on it, then you decide on that safety part. The second part we should look at is liquidity. So will the money be available to you when you need it, or will it be locked in? So if you buy a product like say PPF, which is a 15-year product, you cannot have liquidity at year 1 or year 2 because you don't have any option to pull out money from that product at a shorter interval. So you will not select a product like PPF for something where you need the money in 2 or 3 years. So you look at the liquidity of any product that you're investing, ask how easy it is to remove the money without any penalty or losses. at a certain point in time where you think you will need the money. So that is the liquidity part of it. And then comes the growth part, which is essentially the returns, which everybody focuses on. So you look at safety, liquidity, and growth in tandem. So where there is higher growth, it will likely be that the safety is lesser. Safety in terms of volatility risk. Say if you're investing in stock market, so the stocks can go up and down. So the growth is likely to be higher over a long period of time, but the risk is also higher. Whereas if you look at something like a fixed deposit, the safety is higher because the rate of return is also lower on that, and there is certain risk on that, but the risk is much lower than investing as an equity investor. So you look at a combination of these three products when you're selecting any investment product. Come to the second part of it is the personal attributes. When you're actually selecting any investments, you look at what are your financial goals for which you are saving. So is it a sacrosanct goal? Say if your child is going to college, so you know that in a certain year you will definitely need that money. So you have to match that time frame to this liquidity. The product that you're investing in should give you liquidity at the time that you need it in that particular year. You look at the time horizon. So products like equities are all long-term products. So you have to give equity markets a time to give your money back. You cannot look at equity for a shorter period of time. That will be speculative. So you should ideally look at match your time horizon with the returns that you expect in a particular product or an asset class. And obviously, there is own risk profile that you need to take care. What kind of investor are you? Are you a conservative investor? Then you should not select products like equities. If you are an aggressive investor, again, you should not probably select 100% equity for yourself, depending on your other things. So it's all, it's a combination. You cannot say that if your risk profile is conservative, it will be 100% in debt or 100% in very safe products. So based on your financial goals, based on your time horizon, and based on your risk profile, you arrive at what is the optimal product for you to choose. So this is how you actually select your investment products. I think, yeah, okay, let me just go through this. I don't think we have much time. In estate planning, just two things you need to keep in mind. Nomination, it is necessary, but it is not enough. So nomination is actually not giving you a right to the money that you are getting as a nominee. It is a trust that you are holding. So the nominee will only be a trustee of the funds that are received, but nominee has to give it to the legal heirs of the person. So suppose person A is having a fixed deposit and nominee is B. Now B is not related to, let me make it simple. So the father makes a fixed deposit and the nominee is a son, but there is also a daughter. So legally, the son and the daughter have rights to the father's money if he passes away. So nominee, if the son gets the entire money, the daughter also has equal rights. So the son cannot use the entire money for himself. So nomination is necessary. The bank will pay you the fixed deposit money as a nominee, but somebody else also has a right on that. So how do you ensure that your estate planning, that is after your money goes correctly to the people that you want to go it, make a will and ensure that the nominations and what you write in the will match. Otherwise, if there is a mismatch, there might be a problem. So create a will and put down your wishes about your wealth that you've created through your lifetime, or even if you are starting, you need to ensure. So if you built a house, you need to ensure that you put down if something happens to you, who gets that house. For younger people in the audience, will also helps in another way. If you have children who are minor, if something happens to both the husband and the wife, who will be the legal guardian for the child? So that is what you can write in the will as well. So that becomes a very important aspect. Even if you've not created a large amount of wealth, if you want to safeguard the interests of your children, you can do so by nominating the, putting the legal guardian's name in the will, and that is what will, help in case something untoward happens. Financial hygiene, this is what I request all my clients also to look at. You have to keep your documents organized, because if something goes wrong, if everything is in one place, you will at least be able to gather the documents and act on it. Nowadays, everything has to be exactly correct in all your investments, in all your essential documents, your Aadhaar, your PAN, your bank accounts, your passport, your voter's ID card, all kinds of investments in securities market. So you ensure your name is correct and it is consistent everywhere. And for women, especially post marriage name change, different things happen. Some women keep their name as it is, some women change the surname, keep the name, some women add married surname and also keep the maiden surname. So you decide which way you want to go, decide once and then stay consistent. Don't do flip flop, because if you do this flip flop, okay, I think I will continue with my name, and then suddenly you change, or you change and then you want to go back, so all your financial papers will be in disarray. It will be difficult for you to pull out your money because it will get stuck somewhere because of a name mismatch. So you decide once how you're going to keep your name and stay consistent with that. And obviously you have to ensure that you do your change your name in the gazette, change your name in the Aadhaar and the PAN. All those things obviously have to follow. That is procedural. You have to track your investments. You should be sure where you have put your money. All the bank accounts which are linked to those investments should be live. If you're closing any bank account, ensure that before you close the bank account, you also change the bank details in all your investments. Otherwise, when the maturity comes in and the money is to be transferred and the account is closed, it becomes a lot of paperwork to get that sorted. And you have to be wary of frauds and review what your investments are regularly. Let us quickly run a third poll, which will again be 10 seconds. What is your biggest barrier in investments? Lack of knowledge, fear of mistakes, no time, or someone else handles it? Let's take 10 seconds and make a selection. Okay, let's have the results, please. Okay, so lack of knowledge or fear of mistakes is the highest, and lack of knowledge is second. Okay, so what I would say to this result is, see, if you always are fearful, you will never be able to create wealth. So you keep attending these kind of sessions, learn from it. If your mistakes are smaller in the earlier part of your career, you can always rectify them. To avoid larger blunders, take help of a financial advisor. They will also act as coaches, so you will at least not make large mistakes. So while you have to pay for getting financial advice, the mistakes that can cause the financial losses will not happen. So you will kind of recoup your payments. So that could be one way of looking at it. Lack of knowledge, of course, I mean, we are doing webinars like this, which will help you. There is a lot of reading material which is available on NISM websites, on most of the mutual fund websites. They give very good, investment knowledge. So you can read that. And obviously, if you are having a financial advisor, you can ask questions. So whenever you're also talking to people who are in the field, you should ask questions and increase your knowledge. I think we are out of time, so I will just give you 10 seconds to read through these basic rules. And the next slide, this is how you will start. So if you don't want to make mistakes, you are fearful of making mistakes, I think these are some steps which will definitely help you. And thank you so much. Any questions?
Thank you, ma'am. Now I request attendees to ask their question in Q&A so that ma'am can address those questions. Ma'am, until that time, I think you can touch upon the key takeaways or the session highlights that attendees could remember or anything, something like that.
See, I will take from the last one where people were scared of making mistakes. How do you actually, avoid those mistakes? So unless you do something, you will not know where you're going wrong. So even starting small. So I have an example. A parent started a small 100 rupee SIP for minor daughters so that they know how investment goes. So there were three sets done. So one was in equity, one was in debt, one was in gold, and there was another 100 rupee recurring deposit which was going on. So this is how he was trying to build financial education for the daughter. So when that 100 rupees goes in, they see how things grow differently. So different asset classes, different kind of returns. And also it was a way of bringing in some financial discipline. So if they were able to save a certain portion of their pocket money, the father would add to that SIP. He would put a lump sum into that account. So that is a way of building habits. Now, if you do not understand, take the very, very basic things. So you can read a lot of things about how to start investing, and put some money, talk to people, ask questions, whomever you are going to, whether it's a financial advisor, whether it's a mutual fund distributor, or even insurance agents. If you're going to, just ask questions, try and understand where the money is getting invested and what kind of returns you can expect, what are the risks that are there. And also understand that there are no guarantees. If anybody is giving you a guaranteed return, unless it is a fixed deposit or a similar product, there are no guaranteed returns. So don't believe in guaranteed returns. There will always be a risk, and there will be a certain range of returns that you can expect. Now, whether you are okay to take that risk, go ahead with that and put your money in that. Understand the risk and then put the amount. And as I said, when you're selecting the product, look at all three aspects: the safety of it, the liquidity, and what is the kind of return. So don't just go by the returns that are being promised. Great.
Ma'am, there
Charu
are
Mahesh. Yeah,
yes.
I'll just see the chat box. So Charu Maheshwari has put in a very good point. I've done my PhD on financial well-being recently, and my research area is personal finance. And from my research, I have found mindfulness improves well-being while financial stress hinders it. Absolutely, Charu. I totally agree with it. These days, it's not only financial stress, there are other stresses which are there in life, which are taking us away from mindful decisions. So, mindfulness definitely will improve the well-being overall, not only in financial area but also general well-being in life. So definitely mindfulness is something that we all need to cultivate. It's easier said than done, but it definitely improves the quality of life throughout. Okay, Rupal says, how can beginners start investing while managing risk effectively in today's volatile market? So Rupal, I would say if you are a beginner, look at what is the amount that you can invest. So volatile market कहाँ पे है? The volatile market, if you're seeing the stock market, there is volatility, right? So how long are you going to put your money for? Are you going to put it for next 25 years? Then the volatility today does not matter. In fact, it is a very good chance to enter where the markets are in the doldrums, and you can put your money for the next 25 years. You're good to go. So by beginner, I'm assuming that you are at the beginning of your career. So you don't have much to lose. You've not built your corpus. So this volatility might probably, frighten somebody who has a larger corpus invested in the market and is a little scared about what is happening. But for a beginner, this is a good opportunity. There are other parts of the market which are non-volatile, of course. I mean, there are debt markets where you can invest in something like a PPF, or you have your bank fixed deposits, or you have recurring deposits. So there are always options available. There are always ways to manage your risk. You have to understand what are you okay with, how much risk are you okay taking, what is your time frame, what are you saving for. So once you're able to answer those questions, you will find some solutions to where you need to invest. Thank you, Professor Manavallan, for the kind remarks. Any other questions? Anybody? Lakshya Gupta, how to take decision in investing because I have lack of confidence and making mistakes or have fear. See, it is very difficult to answer this beyond what I've already said in the presentation. I think it is that you need personal coach. You need an advisor who will be able to help you answering your questions. What is actually causing the fear? What are the mistakes that you're afraid of making? So you should approach an advisor who will help you in answering your questions and helping you out with your investments. It's a little difficult to answer beyond what I've already said. Rupal again is asking, what are the ideal investment strategy for students with limited capital? See, there is no ideal investment strategy. So don't look for ideals. You should look for what is optimal for you. So if you are a student and you have very limited capital, why are you investing? I mean, what is the purpose of that investment? Are you looking to fund your higher education? I mean, what is the amount that you're looking at? If it's a very small amount, if we are trying to learn, then everything is open for you. If it's just a learning capital, I mean, if you're not afraid of losing that money, you can try different things. But if you're looking at a certain goal, say if you're going to probably pursue higher education later on, or if you're maybe just saving to buy a vehicle or some particular goal that you have in mind, then you have to be mindful of what things you're choosing. So if it is a short term goal, say you need the money in next 2 years, you will look at assets which are not in the equity domain. So you will look at debt products which will help you uh, you know avoid the volatility, because your time frame is very short. But if you are say looking to uh, kind of build a base for a very very long term, as I said, in the initial part of your career or when you're a student, you don't really have the visibility of what life will bring to you. So if you're looking at it from that point of view, you're looking at financial freedom. I think equity could be a good option for you, because then you have a long, long runway in front of you. You're just a student right now. You will have a career in which you will build. So it depends on what are the answers to the questions that I posed. So if you have those answers which are clear, then you can look at these options. Thank you for the kind comment, Mr. Sanjay. Thank you, Sushma. I think we don't have any more questions. Thank you so much. Thank you for attending the session today, and I hope I've been able to give you some good ideas for investment.
Yes, thank you so much, ma'am. Also, I would like to extend a heartfelt thanks for taking time and speaking at the webinar, and also for sharing your knowledge and time with us. And also thank you to all the attendees, especially women who joined today's webinar. So yes, thank you. Thank you all for joining today's webinar. Yes, thank you.
Thank you so much.
Thank you. Thank you so much, ma'am, again. Thank you.
Bye.
Thank you. Bye. Now I request attendee